Okay, dear students, welcome to everyone. Let's just start the discussion of pre-seen ACCA mock September 2025. Let's just start from the first one. What is the change in annual cash inflows which will make NPV zero? Of course, when examiner says NPV zero, it means it's pointing towards sensitivity analysis. Cosmos company is considering the evaluation of a new project which has a lifespan 4 years. Important information. Lifespan is 4 years. The NPV is estimated 400,000. NPV is 4 lakh. When discounted at an annual rate 10%, cost of capital is 10%. These estimates are based on expected cash inflows 500,000 annually over the project's duration. The applicable corporate tax rate is 30% payable 1 year in arrears. So we are paying tax with a delay of 1 year, number one. Number two, since NPV is after tax, so the denominator, the variable which will be in the denominator, that has to be also after tax. So it's very simple. All we need is just calculate present value of these cash, post-tax cash inflows. Project life is 3 years, but impact will go till 5. Why? Because we are paying tax with a delay of 1 year. So we have got cash inflows 500,000. So every year it will be 500,000. Of course, you can use the annuity factor also, but sometimes that can create a little problem for the student. So you can solve like this. Tax 30%. 1,50,000. 150, 150 and 150. Net cash flows 500,000. 350, 350. Now, of course, we know that we have to solve on a spreadsheet. So by using the shortcut, you can easily calculate present value of all these cash flows. Right now, I'm just solving it without the shortcut. Or let me just, why not to take the benefit of the shortcut? Just a minute. We know the cash flows. Okay. First year it is 5 lakh. Then we have got 350, 350, 350, and last negative 150. Just a minute. Let me pause the video. So video should not be unnecessarily long. T1, 2, 3, 4, and 5. Cash flows. First year it is 5 lakh. Then we have got 350. Again 350. 350. And then we have got negative 150. Cost of capital is 10%. Let's simply calculate present value. By using shortcut of NPV, which is available to you in exam. First, take the rate, comma, select all the values. Students, I'm getting this present value. 115. Okay. NPV they have given us. If I'm not wrong, NPV was 4 lakh. Now let's calculate the percentage change. We'll take this. Student, percentage change. We have to convert this into percentage. Actually, it is 35%. And if I convert this, so basically I'm getting 34.7%. So the percentage change is 34.7%. Logically, if cash inflows they fall, they reduce by 34.7%, your NPV becomes 0. I hope it is clear to everyone. Let's go back to our OneNote. Okay. Even you don't get the exact answer, go to the closest one. Even the answer is 35. So closest option is obviously C. But we got the exact answer, which is 34.7%. Now come here. Should tech company plan to adopt? I hope we are on the right page. Yes. Should tech company plan to adopt its existing capital structure for new investment proposal determining the revised cost of equity for tech in the hospitality sector, round to the nearest whole number? Should tech company plan to adopt its existing capital structure for the new investment proposal determine revise? We just need to calculate revise K. Okay, always remember one point, student, when there is a diversification. In case of diversification, first we need beta asset of the new industry. Once you have calculated, you have found the beta asset of the new industry, just gear up that beta asset with your own gearing. You will get equity beta. Then that equity beta will be used in CAPM. So let's read the question now. Tech companies seeking to diversify into hospitality business given the market saturation in their existing line of business. Tech company aims to ascertain its cost of equity for evaluating the new investment proposal. Sunshine Company is a listed company in hospitality industry. So basically we are diversifying because tech company is seeking to diversify. So in case of diversification, step 1, we need asset beta of the new industry. After that, you have to gear up with your own financial gearing to get equity beta, and that equity beta will be used in CAPM. The existing capital structure and equity beta of two companies are as follows. Read it slowly. It's debt to equity. Tech company, for which we are solving the question. Sunshine, a proxy company in the new industry where you want to diversify. Debt is 2, equity is 3. Equity beta is 2. Assume no corporation tax. So just assume there's no tax rate. Okay, now, first we have to de-gear Sunshine Company's equity beta to calculate beta asset. So simply to de-gear equity beta. So logically now we have to convert this equity beta into beta asset. And don't forget one concept. That concept says equity beta is always higher than beta asset. Because equity beta has got 2 risks. One is financial risk, and another is your business risk. When we say beta asset is a one risk beta which only measures the business risk. So logically, equity beta will always be higher than beta asset. Now we are this will really help you. How? Now we are converting equity beta to beta asset. Whatever the answer comes, logically that answer has to be lower than 2. Why lower than 2? Because we are converting equity beta to beta asset. So we know that equity beta is 2 risk beta. Logically, we are converting 2 risk beta into 1 risk beta. So answer has to be less than 2. How much it is going to be lower than 2? That is not the concept. The concept, it has to be lower than 2. So we need beta asset is equal to beta equity into market value equity divided by market value equity plus market value debt 1 minus tax rate. But question says ignore taxation. If no tax, then simply you can say that beta asset is equal to beta equity into market value equity divided by market value equity plus market value of debt, because question says there's no tax. Beta equity of Sunshine. Beta equity of Sunshine company is 2. Let's say market value equity is 3. Debt is 2. Equity is 3. So simply 3 divided by 5, I'm getting 0.6 into 2, I'm getting 1.2. So beta asset is 1.2, and logically we have calculated correct answer. Why? Because beta asset should be lower than equity beta, and it happened here. Now we need to gear up this beta asset with the tech company's financial gearing. To gear up, beta asset 1.2 with tech company's financial gearing. Okay, so now we need beta equity. Now logically, whatever the answer comes, but that answer must be higher than 1.2. Why why must be higher than 1.2? Because right now we are converting asset beta to equity beta. We are converting 1 risk beta as 1 risk beta to 2 risk beta. So logically 2 risk beta must be higher than 1 risk beta. So beta equity is equal to beta asset. Formula also changes. Market value equity plus market value debt 1 minus tax rate divided by this. If no tax, which is happening here, then formula changes. Beta equity is equal to beta asset into market value equity plus market value debt divided by VE. So beta equity is equal to beta asset, which is 1.2. We have to see the financial gearing of tech company. Equity is 2, debt is 1. Equity is 2, debt is 1. So let's see what we are getting. Students, I'm getting 1.8. Now by using CAPM, very easily we can calculate K. K is equal to RF plus RM minus RF, and then we have got equity beta. Logically, RF minus RF is your equity risk premium. Equity now see the question. Risk-free rate is 3%. Market risk premium is 5%. Another name for the equity risk premium is market risk premium. Both are alternative names. So RF, they have given us 3%. RM minus RF, market risk premium, they have given us 5% into 1.8. So 5 into 1.8 plus 3. Students, KE, I'm getting 12%. So simply in case of diversification, first, we need beta asset of the new industry. Once you have found the beta asset of the new industry, just gear up that beta asset with your own financial gearing. That will give you equity beta and use that equity beta into kappa. Logically, the KE which we have calculated, you can say it's a project specific KE. Okay. What is the current market value of each loan note rounded to the nearest dollar? Actually, how do we calculate market value of debt? Simply market value of debt is, let me tell you. How do we calculate market value of debt? It is actually equal to present value of all future cash flows. For present value, for discounting, you will be using pre-tax cost of debt. Discount factor will be pre-tax cost of debt. What is the current market value of each loan note rounded to the nearest dollar? Let's see. Bubblegum company has 12% convertible loan notes. Now stop. In case of convertible loan notes, actually the lender, the investor, is having two options. One, at maturity, lender can opt for the redemption. Second, lender investor can convert convertible bond to ordinary shares. Obviously, investor will compare the redemption amount with the conversion value, whichever is higher. Bubble Gummy has 12% convertible loan notes outstanding. Maturing in how many years? 5 years times, and to be redeemed at face value $100. Alternatively, each loan note can be converted into 40 ordinary shares, each with a nominal value, par value is $1. After 5 years, the company's ordinary shares are, after the 5-year period, full stop, the company's ordinary shares are presently trading at 2. Right now, one share is having a value of 2, projected to grow at an annual rate 5%. It means if we calculate value of 40 shares in 5 years time, value of 40 shares, not today, in 5 years time. Right now, each share is having value $2, and share price will keep increasing at 5%. And maturity period is 5 years. So let's see. 40 into 2 into 1.05, take the power 5. I'm getting 102.1. Now listen carefully. Of course, when the time of redemption comes, investor lender is having two options. One, to go for redemption, which is $100. Second is to go for conversion, obviously whichever is higher. So the investor will go for the conversion rather than redemption. Okay. Bubblegum pre-tax cost of debt is 10%. So I'll use pre-tax cost of debt. After tax, we don't use it because we are calculating market value of debt. Okay. And this 12% convertible loan note means this 12% is the coupon rate. I'm just writing the cash flows here. Then I'll show you by using shortcut very easily. You can calculate the market value of the bond. T1, T2, T3, T4, T5. Basically, coupon rate is 12%. Nothing is mentioned. Par value is always 100. 12% of 100 is 12, 12, 12, 12. But in the last year, it will be 12 plus the conversion value. It means in the last year, it will be 114.1. In the last year, of course, one, there will be a cash interest of 12. And the second, conversion value, which is 102.1. Discount factor will use 10%. So simply by using the shortcut of NPV, very easily we can calculate market value of the bond. So let me share the spreadsheet with you. Okay. Time 1, 2, 3, 4, and 5. Let us simply write the cash flows. It's actually 12. I can use the option of drag. In the last year, it will be 12 plus the conversion value, which is 102.1. Discount rate is pre-tax cost of debt, which is 10%. Now, very easily we can calculate market value of debt. Simply we'll be using the NPV function. So all those shortcuts which are available, you should be using them. Take rate, comma, select all of them, bracket close. Here comes your answer, 108.89. If we don't get the exact choice, then we'll go for the closest one, nearest one. Let's see. We are back to OneNote. We got the answer 108.89. Let's see the choices. 108.89. Can I say? Logically, option C. Okay. What is the amount of equal annual lease payment for 4-year closest to? First of all, you should know one relationship. Okay, we have present value of annuity amount is actually equal to annuity amount into annuity factor. Present value of annuity amount is actually equal to an annuity amount into annuity factor. Now let's read the question. NPV of the lease agreement calculated 10% discounted yield a negative NPV. We are having a negative NPV. Just a minute. Okay. Negative NPV is 21,003 is equal to the terms of the lease involve an immediate down payment 10,000. Immediate means times 0, 10,000, followed by 4 equal annual payment with the first payment commencing at the end of first year. Now listen. Minus annual payment for how many years? 4 years. So basically, we need this annuity amount. So examiner has already calculated the present value of lease. Basically, we know that all the rental payments, we just need to calculate present value. But here examiner has already given us the NPV. Fine. And an examiner is asking us to calculate equal annual lease payment. Equal annual lease payment means annuity amount. How will we calculate? Very easy. This down payment actually company is paying at time 0. So that is why it is itself in a present value terms. So no need of any discounting to this down payment. It is minus 10,000. If I bring this to the other side of is equal to, it becomes positive 10,000. So obviously positive 10,000 and negative 21,003. We will have minus 11,003. Repeat. Negative 10,000 when I'm going to bring this on the other side of equation is equal to negative 10,000 becomes positive NPV and you will have negative 11,003 is equal to minus annuity. Why minus? Because lease payments. So we are making the payments outflows into annuity factor. Discount rate is 10%. In exam, they do give you the discount rate table as well. I know that I discount rate at 10% for 4 years. Annuity factor at 10% for 4 years is 3.17. Now, logically, mathematically, this negative sign will be cancelled with this negative sign. 11,003 divided by 3.17 will give us annuity amount, or you can say annual equal payment. 11,003 divided by 3.17. I'm getting 3470.9, so make it 71. 347. So actually, annuity amount, or you can say annual lease payment, are 3471. Of course, to do the question like this, you should be The topic of lease or borrow to buy decision should be in your mind. If you can recall that topic, then obviously this question is not going to disturb you. Question number 5. Indicate by clicking on the relevant boxes whether the following statements are true or false in relation to working capital. The primary objective of working capital management to balance between the profitability and liquidity. That is true. It's very true. In working capital, actually, we try to maintain a balance between profitability and liquidity, which is very true. Under invoice discounting, the entity usually transfer control over the entire receivable ledger. That is false. That happens actually in factoring. It does not happen in invoice discounting. An aggressive approach to working capital financing can increase profitability too, because an aggressive approach of working capital financing means you will be focusing more on short-term financing, for example, OD. And obviously, OD will be used on as and when required basis. Normally, there's no need to pay the interest throughout the year because OD you will be using whenever you need it. So then there's a possibility that profitability of the company might increase. So true. In the factoring with recourse, the company is insured against the bad debt false. In factoring without recourse, if it is a non-recourse factoring, then your bad debts are insured. In case of with recourse factoring, the risk of bad debt belongs to the company, it does not belong to the factor organization. Okay. What is the theoretical X right price? TRP per share, rounding to the nearest whole number. Okay. Snow Company intends to initiate 1-for-3 right issue, offering shares at a 20% discount to the current market price. Presently, the company's EPS is $2 with shares trading at an earnings yield 5%. Earnings yield is 5%. Additionally, Snow Company's market capitalization is valued at 240 million. Okay, fine. Now, earnings yield. Let me just first write. If you recall price earning ratio, P ratio, the formula of P ratio is P naught upon EPS. Earnings yield is the inverse of P ratio. Earnings yield is the inverse of P ratio. It means EPS upon P naught. Now, earnings yield examiner is giving us how much? 0.05 because it is 5%. They're also giving us EPS, which is 2. We don't know P naught because we do need P naught. After that, we can calculate TRP. Now, very easily, I can calculate P naught. Logically, it will become like this. Basically, we are P naught is in the denominator. If it will come here, then 0.05 and P naught, they will be multiplying with each other. Then 0.02 will go to the other side of the equation, and that comes in the denominator. So let's see the current share price. 2 divided by 0.05. Current share price $40. The right issue price is at 20% discount. If right issue is issued at 20% discount, it means right issue price is 32. We need to calculate theoretical X right price ratio they have given us. Shares values and total value. 3:1. Share price before right is 40, right price is 32. Just multiply them, I'll get 120 and 32. We can say that 4 shares are having total value 152. Theoretical X right price means share price after the right issue. So here comes the TERP. If 4 shares are having total value 152, then what is the value of 1 share? So 152 divided by 4. I'm getting 38. So logically, theoretical X right price is 38. Theoretical X right price is 38. Okay. Which two of the following statements regarding financial market and economic policies are correct? Which two of the following statements, so out of 4, 2 are correct, regarding financial markets and economic policies are correct? Higher taxation is expected to boost overall demand within the economy. No, no, no. Can I say simply false? Because higher taxation will discourage even the investments. Supply side policies will lead to raise capacity of the economy in producing more goods and services. True. For example, if the money supply is available and there's a rise in the money supply, then obviously there will be more businesses regarding production, regarding services. So supply side of policies will lead to raising the capacity of the economy in producing more goods and services. When there will be money in the economy, definitely you will get the benefit in case of production and services. Maximizing market share is an example of corporate financial objective. Actually, market share is a non-financial objective. It's not a financial objective. Peer-to-peer allows people to lend money directly to small businesses without going through a formal financial institution. Yes. So in peer-to-peer lending, you can directly lend money to small businesses without going through a formal financial institution, means there's no need of the bank. Question 8, which of the following statements regarding value for money are correct? Which of the following statements regarding value for money are correct? Acquiring resources at the lowest cost. True. Implementing innovative marketing campaigns, it has nothing to do with the value for money. Value for money is not implementing innovative marketing campaign. Maximizing shareholders dividend, that's when you're maximizing shareholders dividend, how come it is value for money? Ensuring maximum output within the given resources. Make sure that resources should not be wasted. You should be getting maximum output with given resources. So logically 1 and 4. Okay. In a booming stock market, investors observe rapid price fluctuations following the release of listed companies' annual report. Which form of the market? Students, when the information has been made public and the reaction from, let's say, investors, they will come. If reaction from the investor, reaction from the shareholders is coming after information has been made public, then it actually represents semi-strong efficiency. Semi-strong. Assuming 365 days in a year, what would be the yearly reduction in the finance cost? If management shortens the collection period, look, read it nicely. They're not saying collection period will become 40. They're saying collection period will reduce by 40 days. Read it again. Of course, when your collection days will reduce, your datas will reduce, and when there's a reduction in the datas, you will save the finance cost. So if you read it again, assuming 365 days in a year, what would be the yearly reduction in the finance cost if management shortens the collection period by 40 days? If collection period is shortened by 40 days, so we can directly calculate reduction in datas. And reduction in data multiplied by OD rate will give you saving in the finance cost. So simply saving in finance cost is equal to reduction in datas multiplied by OD rate. So it says management shortens the collection period by 40 days. So we can directly calculate reduction in datas. Reduction in datas. Your annual credit sale is 50 million. Datas will reduce by 40 days. So 50 million. Students, I'm getting 547. 5479452. Now we just need OD rate. OD rate is 10%. That will give us saving in finance cost. 54794.5.2. 547,945 points. Can I say C? So simply reduction in datas into OD rate. Okay. Consider the following statements related to capital asset pricing model. Investors can eliminate the unsystematic risk through diversification. Can I say true? In fact, in capital asset pricing model, we do make an assumption that investor is having a well-diversified portfolio of investment. Due to that, unsystematic risk is zero. The systematic risk affects the market as a whole. Yes. Basically, systematic risk is the risk which you have to face. An entire market faces, we cannot diversify that. So both the statements are correct. Should the loan interest rate on the date when the loan is taken up 10% per annum, what is the payment or receipt company A will make or receive with FRA bank? Actually, what happens in interest rate hedges, if you go for FRA forward rate agreement, so number one, FRA is an OTC product. OTC product means over the counter product which is available from banks. It's a tailor-made product. Normally what happens, due to FRA, interest rate becomes fixed for you. Assuming under FRA interest rate is 10% for you, but actual rate, assuming actual rate becomes 7%. First you will be paying 7%, then you will have to pay the 3% to the bank from which you have taken FRA. If, for example, you have taken the FRA at 10%, actual rate becomes, assuming 15%. It does not happen, but just assuming. You have taken FRA at 10, but actual rate becomes 15. First, you will be paying 15% interest, and then 5% will be returned to you from the bank from which you have taken FRA. So under FRA, basically interest rate becomes fixed for you. It cannot increase, it cannot reduce for you. Should the loan interest rate on the date when the loan is taken up is 10% per annum, what is the payment or receipt company A will make or receive with FRA Bank? Let's see. Company A manufacturing entity finds itself a need of 4 million loan for 6 months period. Time period of borrowing is 6 months, which it requires in 3 months time to facilitate expansion. So in 3 months time, they need the loan of for 6 months. So FRA will be 3 versus 9. The second one. For you, the rate has become 12%, which is fixed. To mitigate potential risk stemming from interest rate fluctuation, company A is conceding to FRA. So the first is not relevant for us. The second one is relevant for us. Should the loan interest rate on that date when the loan is taken is 10%. Now listen, if the day you are taking loan on that day, interest rate is 10, but you have to pay exactly 12%. First, you will be paying 10% to the bank from which you are taking loan. Then you will have to pay 2% to the bank from which we have taken FRA. Because interest rate cannot be less, cannot be more than 12%. So to the bank from we have taken FRA, we have to pay them 2%. So number one is a payment. So company A pays to the bank due to FRA. The loan is 4 million. You will have to pay 2% into 6 by 12. Let me use the calculator. 4 million. Students, I'm getting 40,000. So we have to pay to the bank 40. We have to pay to the bank 40,000. Okay, indicate by clicking on the relevant boxes in the table below whether each of the following financial. Okay, question is there. Any question you can ask, please. Let me just pause the video. Okay, you can ask during the video. Is there any question? Please, should I show you the calculation? Student, I'm just pausing the video. You can ask the. Okay, there's a question from the student. Why did we choose 3 into 9? Come here. Company A manufacturing entity finds itself need 4 million loan for a 6 months period. Time period of borrowing is 6 months. And when do I need this loan? Which it requires in 3 months time to, we don't need loan today. We need this loan actually after 3 months for 6 months. So time period of borrowing is 6 months. Now come here. The difference between 3 to 6 actually represents the time period of borrowing. The difference between 3 and 6 is 3 months. And first one shows that your time period of borrowing is 3 months. But my time period of borrowing is not 3 months. My time period of borrowing is actually 6 months. And that 6 months, they're not starting today. They will start after 3 months. So 3 versus 9, that is why we have chosen. I hope it is clear now. Because the time period of borrowing is 6 months. First FRA shows the time period of borrowing is 3 months. The second one is the relevant one for us. Because we will take loan after 3 months for 6 months. Okay. If, for example, if it is written like this or this, it means the FRA will start in 2 months time, ends in 5 months time. So time period of borrowing or lending is 3 months. Okay, students. Indicating by clicking on the relevant boxes in the table below whether each of the following financial instruments that are commonly in use by organization are of short term or long term. Commercial paper is short term. Commercial paper short term. Preference share capital obviously long term. Treasury bills short term. Banker acceptance of course short term. So banker acceptance you will only get from the bank, and it is again short term. Wow, wow, wow. This multiple choice looks very big. Which of the following statements accurately describes the difference between the traditional theory and theory regarding capital structure? If you recall traditional theory, according to the traditional theory, organization they should maintain a balance between debt and equity, and by keeping that balance between debt and equity, they try to reach to a capital structure where cost of capital is let's say as low as possible, but you have to maintain a balance between debt and equity. Let's see. The traditional theory assumes that costs of capital remain constant. No. If you recall, under traditional theory, what happens? When you start increasing debt, then your WACC will keep reducing. The traditional theory asserts that the value of the firm is unaffected by the changes in capital structure. No. It is no tax world which says cost of capital, simply no tax world says capital structure is irrelevant. No tax world says that value of your business, value of your company will be same either there's gearing in your company or not. It is not the traditional theory. The traditional theory emphasizes the importance of minimizing weighted average cost of capital through optimal capital structure design. Optimal capital structure is a structure where there is a minimum cost of capital. While theory argues that capital structure decisions are irrelevant and to WACC in a perfect capital market. Logically, the D1. Let's read last one also. The traditional theory advocates for maintaining the balance of mixed debt and equity to maximize your. No. They're not after maximizing the actually shareholders. When what's it? While the theory suggests that firms should minimize the financial risk by avoiding debt. If you recall, is having more focus on debt financing. So logically, it was 1, 2, 3. Third statement, third is correct. It is option C. The statement 1, 2, statement 3 is correct. Okay. Which of the following is most likely to cause country's currency to appreciate? Which of the following is most likely to cause a country's currency to appreciate? Let's see. The country consistently runs a trade deficit. If you have a trade deficit, so it will depreciate the currency. The country experiencing higher inflation compared to a foreign country. Can I say higher inflation means your currency will be depreciated? The domestic interest rate rise. Now, the third one, there's a possibility due to third one, your currency can be appreciated. How? I'll explain. The country experiencing uncertainty due to political unrest. If there is uncertainty due to political unrest, then currency will not appreciate, it will depreciate. Now the question is how it is possible that domestic interest rate rises and then there are chances that your currency will appreciate. There's a possibility. For example, if in number of foreign countries assuming interest rate on deposit is 2%, assume. We are assuming that there are number of foreign countries where on deposit interest rate is only 2%, but in our country, assuming, we are having a deposit rate of 10%. Now try to understand. If other countries, they are giving 2% return on deposit, and we are giving 10% return on deposits, then there are more chances that we can attract foreign exchange, that they are going to keep that foreign exchange in our account. So we'll be having more foreign currency, more foreign exchange. So basically, if it, then there's a possibility it can appreciate your currency. It is a very common practice in our country. There are, I would say, a very big amount of dollar is by the, I would say, overseas Pakistanis. They have deposited in the bank because here the return is far more higher than depositing that amount in foreign country. So C is most likely to appreciate the country's currency. Now let's go to section B. Just a minute. I want everyone just try to read the scenario once. I hope now you can read. Just read the scenario once and then we start. And don't worry, I'll give you the idea on section C as well. Okay, so let's start section B. Determine the EOQ. Decide the EOQ. Economic order quantity for component A prior to considering the quantity discount to the nearest whole number. Units. So they are simply saying calculate EOQ. Let's see. Economic order quantity is equal to 2D C naught upon CH. D is the annual demand. C naught is the per order cost. CH is the per unit holding cost. Let's see. Jim Ford Enterprise specializes in manufacturing electronic gadgets. Due to previous challenges with suppliers' timelines, Jim Ford has maintained a significant inventory of electronic components to ensure uninterrupted production. No, it's fine. However, with recent improvements in supplier reliability, Gimford reassessing its inventory management strategies and recalculating EOQ, economic order quantity. One component labeled component A incurs a purchase cost 1,000 per unit. For Gimford, the expected annual usage of the component is 65,000. Students' annual demand is 65,000. Gimford incurs procurement costs, including order placement, processing, amortization. Per order cost C naught is 2,500. Furthermore, the holding cost for 1 unit of component A for 1 year is 30% of the inventory value. Inventory value is 1,000 per unit. So 30% of that is your holding cost, which is $300. So per order cost is $2,500. Holding cost is $300. So let's come. 2D. C naught is 2,500. CH is 300. Whatever comes, will take power. 1 upon 2 means power will be 0.5. Let's use the calculator. 2 multiplied by 65,000 into 2,500 divided by 300. Power 0.5. Students, I'm getting 1040.833, so 1041. So logically 1041. Nearest whole number is 1041 units. Straightforward. I strongly believe should not be having any issue at all. Now, the next one. The total inventory cost under EOQ model is correctly calculated at, I would say this is 65.312 million. What is the financial consequence of accepting 2% quantity discount? So you have to tell us if we go for 2% quantity discount. So are we having a benefit? If yes, how much? So we have to actually, you have to calculate annual inventory cost with this 2% discount. First, we'll be calculating ordering cost. Annual demand, we know that, which is 65,000, but in order to get 2% discount, what will be the order size? Notably, Gimford's supplier offers a 2% discount on the price of component A if an order quantity is 2,000 units or more in place at once. Per order cost is 2,500. 65,000 divided by 2,000 will give us number of orders annually into 2,500 will give us total ordering cost. 65,000 divided by 2,000 into 2,500. Students, I'm getting 81,250. Now holding costs. There is an assumption that 50% of the order size will be in the warehouse throughout the year. 50% of your order size. Now order size is 2,000 divided by 2. Order size is 2,000. Of course, 50% of that, how will you calculate? By dividing 2, you will calculate. So the assumption is 50% of the order size is in your warehouse all the time. Multiply by per unit holding cost. Now listen. Holding cost for 1 unit of component 1A is estimated 30% of the inventory value. And we buy that for $1,000. Now try to understand. Now for you, the price is not $1,000. If you're getting a 2% discount, logically for you, it will be 1,002.98 and 30% of that. So it means your holding cost will change. It is 294. Now it is not 300. So 2,000 divided by 2 into 294, I'm getting 2,94,000. I'm getting 2,94,000. Okay, now purchases cost. Annual demand is 65,000. Purchase price of 1 unit is 1,000, but we'll be getting a discount of 2%. So that's why 0.98. 65,000 into 1,000, then 98% of that. 6,370,000. So 63.7 million, you can say. Now here comes the total annual inventory cost. Ordering plus holding plus purchases. Let's see, what are we getting? I'm getting 64.07 million, I believe. This will be our annual inventory cost with that discount. Examiner has already calculated. You can see that cost with EOQ is higher than the cost with discount. See the benefit. Annual benefit, annual saving. If we get the discount, we'll be having annual saving. And that will be 65,312,250 minus 6,475. Let's see the annual saving. Students, we are getting annual saving 123700. So by getting a discount of 2%, we are having annual saving. Let's see. Number one, there's a benefit per year. So by getting the discount, we are having a benefit. Okay, now let's see this. Question number 18. In the context of procurement strategies, which of the following statements regarding JIT? Always remember one point. You will not be able to achieve JIT until unless you have a very good relationship with the supplier. And supplier is going to keep the inventory near to your production site. JIT involves maintaining a large inventories to ensure unwrapped. Can I say under JIT we hold very little stock. JIT aims to procure goods from supplier at the earliest possible time. What do you mean early? What do you mean earliest possible time? Again, I'll end up by having too much inventory. JIT increases dependence on supplier for quality assurance and on-time delivery. That's true. Actually, in JIT, I will not be having that much time that first my supplier is going to deliver the products to me, and then I'll take those products then I'll take that material to the inspection department, and then inspection department says, okay, it is fine. Then I'll start the production. I don't have that much time in JIT. So in JIT, obviously, I am going to depend on the supplier regarding quality assurance and on-time delivery. JIT implementation may result in a high inventory holding cost. False. Actually, if we implement JIT, then inventory holding cost should be very low. Which of the following assumptions are necessary for the application of EOQ? Which of the following assumptions are necessary? Demand is known and remain constant. Yes, it is one of the assumptions of EOQ. Lead time to remain constant. That is also one of the assumptions of EOQ. Ordering costs for each order and holding costs per unit per annum are known and remain constant. That is another assumption. The order quantities receive in parts, not together. Come on. This is not the EOQ assumption. Unit cost of item changes with the quantity. Oh, no. There's no such other. 1, 2, 3. ABC. Which of the following are benefits for a company offering a discount to customer? Early payment of invoice. Early payment of invoices. Better liquidity. Yes. Obviously, if you are providing discount to your customer on early payment, so automatically your liquidity will improve. Then less interest as less or no OD will be required. That's true. Why? Try to understand, if my customers, they are paying me earlier, why would I need OD? Or even I need OD, so it will be far more less than when my customers, they were not getting the discount, they were not paying me earlier. So logically, when my customer pays earlier, so there will be a reduction in debtors. I'll be saving the finance cost. True. Risk of more irrecoverable debt as customer take. Come on. Can I say, when we provide discount and I'm going to get payment from my customer earlier, so it actually results in saving of bad debts. Loss of customer who do not take that one. Come on. Actually, normally what happens, we give the option. It's just an option with the customer. That we have given the option to the customer. If you want, you can get the early settlement discount. It does not mean if you don't want to get early settlement discount, we will not sell you the goods. No. If you're not getting the discount on early payment, then you just make the payment on normal credit terms. 1 and 2. So I would say pretty easy question. Okay. Now we have got question from 21 to 25. Student, just read the scenario once, then we are solving it together. Just read it once. Okay. Question number one. Determine the base equity value for horizon industry using net realizable value basis. Base equity value for horizon industry using what? Net realizable base value basis. When we are using NRV basis to value the business, it means logically we can say that going concern assumption is not valid. Let's read the scenario. Sunrise Enterprises is contemplating making an offer to acquire Horizon Industries. Sunrise, they want to buy Horizon. It is expected that upon completion of the acquisition, the current management team of Horizon Industries will retire, paving the way of new leadership. This transition is forecast to generate pre-tax salary saving 30,000 per year. Okay. Since Horizon Industry is not publicly listed, it's a private company. A published P ratio for the company is unavailable, which is logical. However, Radiant Innovations, a comparable entity to Horizon Industry, currently boost P ratio 9. So logically, we'll be using 9 if it is required. But right now, we need net realizable values of the net asset. The statement of financial position of Horizon Industry 31st December X6 was as follows. We have got as total asset 207. We have got non-current liabilities 80, current liabilities 18,000. Additional details regarding Horizon Industries include the non-current asset have not undergone revaluation for several years, and it is estimated their current replacement value is 3 lakh. So whatever is the current value available, I'll use that, which is 300,000. Now just come here. So instead of 150, I'll use the value 3 lakh. 10,000 worth of inventory is considered obsolete. Right now, inventory value is 10,000, 35 minus 10. Why minus 10? Because it is considered obsolete. Could be sold for 1,000. So I will deduct 10. I will add 1,000. So just a minute. I'll get 26. Okay. If regarding any other asset, examiner does not give us any information, then whatever written in the SOFP will take that value. The net realizable value of rest of the inventory is same as the book value. The receivable are fully realizable. 20. Cash at bank is 2. Now just come here. I'll show you something. Determine base equity value. Now always remember that your equity is actually equal to net assets. When we say net assets, total assets minus total liabilities. So examiner is here asking what is the base equity value, means what is the minimum value of equity by using net realizable values. So minimum equity value, and equity is actually equal to net assets. Net asset means total asset minus total liabilities. So we have got 80,000 loan notes, 18,000 payables. The total liabilities are 98. So 300,000 plus 26,000 plus 20,000 plus 2,000 minus 98. Students, I'm getting 2,50,000. I'm getting 2,50,000. Let's see, do we have any choice? Okay, just right. Based on the most recent EPS, what is the equity value of Horizon Industry using P ratio method? Now listen. P ratio is equal to P naught upon EPS. Or you can also say P ratio into P ratio into EPS will give us P naught. Once I have calculated P naught, then market value of equity is equal to issued shares multiplied by P naught. And how do we calculate issued shares if they are not directly given to you? Share capital divided by par value will give you issued shares. In the question, it is written that Horizon is a private company. It's not a listed company, but examiner has given us the comparable P ratio for Horizon. So you will have to use that. It is categorically, specifically mentioned that this P ratio is comparable to Horizon. So obviously I have to use that. 9. Now we need EPS of Horizon. Earning per share X6 amounted to 85 cents. So they have given us EPS. Thank you very much. P ratio is 9, EPS is 0.85. Let me use the calculator. 9 into 0.85. Students, I'm getting 7.65. P naught of Horizon is 7.65. Okay. Ordinary share capital is 25,000. Ordinary share capital is 25,000 divided by par value, which is 0.25. So let's see the number of shares. 100,000. Ordinary share capital is 25,000 divided by par value. It gives you number of issued shares. They are 1 lakh. And P naught we have calculated, which is 7.65. So market value equity is simply 100,000 issued shares by Horizon. Current share price is 7.65. It becomes 7,65,000. Which valuation method would be advisable for Sun Enterprise? Okay. If their intention is to purchase Horizon Industries and subsequently dispose its assets individually. If this is the case, go for NRV, net realizable value. Because NRV will exactly tell you, this method will exactly tell you what is the value of each asset. Read it again. Which valuation method would be advisable for Sunrise Enterprise if their intention is to purchase Horizon Industries and subsequently dispose its assets individually? NRV. Okay. Which one of the following combinations of possible share price reaction increase no effect would you expect on 2nd January X2 under the semi-strong and strong form market efficiency? Okay, let me tell you one thing. Actually, when we say strong form efficiency, the assumption behind a strong form is that a stock exchange is a perfect capital market. BOD and shareholders, they are having the same information. And in case of strong form efficiency, if you make a really good decision, even you are not announcing it's okay, automatically the impact of that decision will be reflected in the share price. But in case of semi-strong, in case of strongly efficient market, your share price actually reflects the past of your business, the information which has been made public. In fact, the share price also reflects the insider information also in case of strongly form efficiency. In case of semi-strong, share price only reflects the past of the information past of your company and the share and the information which you have made public. For example, if you are making, if you're going to make an investment in a project which is going to give you a positive NPV in a semi-strong market, you have to announce. After your announcement, impact will come into the share price. Okay. Sunrise Enterprises receive a confidential takeover proposal from a rival company on 30th December X6, offering to acquire all of Sunshine shares at 35% premium, which is a very handsome premium, over their current market price. On the same day, at a private meeting, Sunrise directors agreed to accept the offer, and decision was publicly announced on what? See, offer was on 30th June X6. And you are saying we are announcing on 2nd January. Now come here. Share price reaction semi-strong. Of course, if it is a semi-strong market, then on 2nd January X7, when you will be announcing, then share price will increase. Okay. Now, in case of strong firm, now listen carefully. You are announcing on 2nd January. In case of a strong firm efficiency, the impact of this information to your share price would have already reflected on 30th December X6. Before the announcement, the effect of this information is already included in the share price, which means that if you announce today on 2nd January X7, in case of a strong firm efficiency, it will have no impact on the share price, because in case of a strong firm efficiency, the impact on the share price is already there came on 30th June X6. Now let's see. So 2nd January, there will be no effect in case of a strong firm. So we have got no effect. Semi-strong, it has to increase. So let me repeat. In case of semi-strong efficiency, when you make an announcement, then share price will increase. But in case of strong firm efficiency, impact is already there on 30th June X6. On 2nd January, when you will be announcing it, it will have no impact on the share price in case of a strong firm. Which irrational behavior of investors involves following the crowd? Following the crowd means you are following others, often leading to a stock market bubbles. Semi-strong, no, come on, that's no. Market paradox. Actually, in market paradox means when there are a number of options, it confuses the investor. It creates anxiety in the investor. It is saying something else. Which irrational behavior of investor involving following the crowd? That is herding. In herding, basically what happens, we start following others. When you start following others, that can create a stock market bubbles. Loss aversion. Loss aversion means I will not be making any investment where there's a even small chance of loss. So irrational behavior of just following the crowd, which is herding, that can lead to a stock market bubble. Again, student, I would say a decent question. Now, the next question. It is on Forex. So I really want you to just... Okay, so let's try it together. I hope you have read it. Calculate the expected net sterling receipts in 1 month time using forward market to the nearest whole number. Expected net sterling receipts in 1 month time. 1 month. Okay. Volco company, a UK based company, it means the local currency, domestic currency is pound sterling, anticipates a receipt of $2,40,000 in 1 month's time, followed by a payment $1,40,000 at the same time. Stop. Currency is same, timing is same, so we have to net off. Receipt is $2,40,000. Payment is $140,000. net receipts. So actually we need to hedge net receipt 1 lakh in 1 month time. And expects receipts totaling 300,000 in 3 months time. Okay. The finance manager has collected the following information. Spot rate is dollar per pound. Foreign currency divided by local. Indirect code. In case of indirect code, rule of translation is division. We divide in order to translate. And indirect code, we buy low, we sell high. Indirect code, we buy low, we sell high. 1 month forward. So can I say 2.5? Simply 100,000. I'll get exactly 40,000 if I'm not wrong. Yes. Indirect code, we buy low, we sell high. How do we identify indirect code? By looking at the exchange rate sign. If in the numerator there's a foreign currency, denominator local, then it is indirect code. So 40,000. Calculate the expected selling receipts in 3 months time using FRA, forward rate. Okay, forward 3 months time. In 3 months time, we have got $3 lakh receipts. It's very straightforward. I would say 1 lakh is the answer. It looks that examination team is very nice towards you. What will be the equivalent pound sterling value of the expected receipts in 3 months time using a money market hedge? Money market hedge, receipt. Actually, money market hedge, receipt means money market hedge, receipt means foreign exchange asset. For a foreign exchange asset, you need to create a foreign exchange liability. So step 1 is borrowed amount. We will not borrow the exact $300,000. We'll borrow the present value of $300,000. Let's see the dollars borrowing rate. Dollars borrowing rate. It is 12% for the whole year. For 3 months, of course, it is 3%. So divided by 1.03. We are just discounting that 300,000. Students, I'm getting 2,91,262. Now deposited amount. We need to convert 2,91,262 by using spot selling rate. Why selling rate? Receipts. So you'll be using selling rate. Indirect code, we sell high. Spot selling rate is 2. Just divide this by 2, we'll get pound sellings. 2,91,262 divided by 2. Students, I'm getting 1,45,631. Now simply add interest income. 1,45,631 into pound sterling deposit rate. 1 year sterling deposit rate. 1 year sterling deposit rate, 10%. But we'll be depositing only for 3 months. Student, I'm getting 3,641. 1,45,631 plus 3,641. 1,49,272. 1,49,272. Wow. Twice B, beta. What is the impact of a fall in the country's currency? If my currency is getting depreciated, fall, export will be given a stimulus. Yes, true. Always remember, when local currency is being depreciated, it encourages the export. Like if I just give you the example, the way back like the rate was the way back. Pakistani currency was very strong. Now it is weak. So weaker currency means when now $1 is being converted into many Pak rupees. So simply, when your local currency is weak, it encourages the export. The rate of domestic inflation will rise, yes. Of course, when there's a higher inflation rate, then currency will devalue. So both are correct. What is the impact of fall in a country's currency value? Both are the impact. C. Which of the following characteristics is typically associated with the forward contract? See, forward is an OTC product which is available from banks. It is tailor-made. Tailor-made means which is not standardized. Tailor-made means which is not tradable. These are the exchange traded instrument false. They are not tradable. They involve standardized terms and conditions false. I just told you forward is an OTC product, over-the-counter product, which are available from banks. They are tailor-made for you. So they are not standardized. Legal binding contract which predetermines the rate for a future transaction, 100%. It's a legally binding contract where simply exchange rate becomes fixed for you. They are a right, but not the obligation to buy or sell. Come on. Can I say, when you say you have a right, not the obligation, then you're talking about options. Here, you're not talking about options. You're talking about forward contracts. Okay. Now, let me just give you a quick idea for the part C as well. So, okay. Okay, so as far as this first question is on, they're asking you to calculate NPV of the investment. I'll just give you an idea that will 100% help you to solve the question. Nexus PLC, a prominent player in the automobile industry, is in the process of planning to set up its own engine oil processing plant. The initial market survey incurred a cost to like 25,000. Can I say sunk cost? This 25,000 is irrelevant. For a setting up plant, is your initial investment is 8 lakh. 25,000 is sunk cost, past cost, irrelevant. The new project life is expected to be 4 years. And the company expects salvage value, scrap value, of course, relevant 250 at the end of project life. So T4 scrap value will be 250. Demand they have given you in liters 200468. Selling price is 100. Variable cost is 30. So obviously 2000 multiplied by 100, you will get a sale of first year, which will be 2 lakh if I'm not wrong, then 4 lakh, 6 lakh, 8 lakh. Then you can very easily calculate the variable cost also. Just you need to multiply with the demand. The annual fixed cost is estimated 100,000, which will include 60,000 of depreciation. So out of this 1 lakh, I will deduct the 60,000 irrelevant because depreciation is not a cash outflow. And 10,000 apportionment overheads. Apportionment, if you recall, I said many times in my regular classes, apportionment overheads, allocated overheads, even ABC allocation, all are irrelevant. So we are left with 30,000. It means the relevant fixed cost is only 30 because examiner has given us fixed cost 1 lakh, but then examiner has given us more information that out of 1 lakh 60,000 is representing depreciation out because it's not a cash flow. 10,000 is the apportionment out because apportionment of your overheads obviously irrelevant. So logically, the relevant fixed cost is 30,000. Okay. Next, space corporation tax 33% payable in 1 year is we pay the tax with a delay of 1 year. If project life is 4, impact will go till 5 because in T5 you will be showing the payment of year 4 tax. Additionally, working capital equivalent to 10% of annual sale is required at the start of each year and recovered at a project's completion. I'll just show you the working capital calculation. looks little important. T1, T2, T3, T4. Sales is going to be 2,200, 2 lakh, 4 lakh, 6 and 8 lakh. 2 lakh, 4, 6, 8. 10% of that we will be investing in working capital. 20,000, 40, 60, 80. Okay. Now, how we'll show this in our final presentation? I'll show you. I'm just giving you the idea how to deal with the working capital. T0, T1, T2, T3, T4. Of course, for T0, I'll be investing in, for T1, I'll be investing in T0, working capital and recovery. 20,000. Now, from 20, I'll go to 40. You have already invested 20, so additional 20 will come. 40, from 40, I'm going towards 60, so I've already invested 40, so additional 20. Then again, additional 20. Then at the end of the project, whatever we have invested in the working capital, it will be recovered because working capital can never be consumed. In T5, there will be only tax payment. And I've already discussed in my regular classes many times that you are advisable to deal with the working capital after you have calculated tax payments. Because if you are showing working capital before calculating the taxation, then definitely your taxation values will be incorrect, because we do not pay tax on working capital. The nature of the working capital is current asset. So simply what are you going to do? You'll show the sale minus variable cost minus fixed cost. It will give you a taxable profit. On that taxable profit, you will calculate tax. Then you will deal with the working capital plus, let's see, any capital allowances. Yes. Nexus company has a cost of 10%. Company can claim tax allowable depreciation 25% reducing balance basis. So very easily we will be calculating tax saving from capital allowances. So two things it is always advisable to deal after you have calculated the tax payments. One, tax saving from capital allowances always show after you have calculated the tax payments. Second, deal with the working capital after you have calculated the tax payments. And of course, scrap value we also show at the end, because we are not paying any tax on the scrap value. So I believe with this explanation, you can very easily calculate NPV of this project. The CFO suggested using NPV for investment appraisal, emphasizing the method's alignment with the long-term objectives. However, some finance manager express concern as their performance evaluation compensation are more tied to the annual profits. Okay. What are they asking? Discuss two differences between NPV and IR also in the context of mutually exclusive project. Discuss which method is preferable. Now, two differences between NPV and IRR. Number one, in IRR, we have the assumption that cash flows are reinvested at IRR. In NPV, we have the assumption that cash flows are reinvested at cost of capital. This is the number one difference. Number two difference, in case of non-conventional cash flows, there will be multiple IRRs for the same project. But in case of non-conventional cash flow, there will be one NPV. So these are the differences. You can say more differences also, that NPV is an absolute measure. Positive NPV means they will exactly tell us the wealth of the shareholder will increase by this amount. IRR is not an absolute measure. IRR is a relative measure which gives result in percentage, and percentages can be misleading. Okay. Now, in the context of mutually exclusive, if student you recall, what is the meaning of mutually exclusive project? Means rule of OR. Rule of OR means I can opt one. If my examiner says two projects are mutually exclusive, I'm going to opt any one of them. Okay, now listen. In case of mutually exclusive project, it is highly advisable to go for NPV rather than IRR. In fact, IRR should not be used in case of mutually exclusive projects. Why? Because there is a possibility that on the basis of IRR, you might end up by opting a project which is not so beneficial for the company. Why? Because if there are 2 or 3 projects, they are mutually exclusive. I have to opt one of them. If you are making a decision on the basis of IRR, which you should not be in case of mutually exclusive, but if you are making a decision on the basis of IRR, then obviously you will be opting a project which is giving you a higher IRR. Now listen to me carefully. It is not necessary the project which is having higher IRR will have a higher NPV. Not necessary at all. It is possible, but I'm saying there's no such concept. It's not necessary the project which is having a higher IRR will have a higher NPV. Not necessary at all. In fact, there's a possibility that a project which is having a higher IRR might have a lower NPV. And NPV is better than IRR. So basically, in case of mutually exclusive, do not use IRR. If you go for IRR, in case of mutually exclusive, then there are chances you might end up by accepting a project which is not beneficial for the shareholders. Now, comment on CFO preference on NPV for investment appraisal. Now, listen, of course, NPV is the better investment appraisal technique. There's no doubt about it. It's an absolute measure which will let you know exactly the wealth of the shareholder will increase by which value. But you're forgetting one thing. What is that? CFO suggests using NPV investment appraisal, emphasizing methods alignment with the long-term objective. However, some finance managers express concern as their performance, evaluation, compensation are more tied to annual profit. Now, listen, practically, those people, they are involved in investment appraisal. Actually, they are more concerned about their bonuses. They are more concerned about their remuneration packages. They know that if a project is having a really good NPV, let's say positive NPV, and it will give the benefit to the entire company, it will give the benefit to the shareholders. But the life of the project is, for example, 10 years. It means that the benefit will come in 10 years' time. So obviously, in the short term, they will have nothing to show that whatever happens, it will take 10 years. So even though the project is beneficial for the entire enterprise, for the shareholders, but since it's a long-term project and majority of the manager, they don't see themselves in any organization for a longer period of time. That is why they try their best to accept the project which is having a shorter life, which will have a good impact in a short period of time, so that they can get high, they can be paid, they can get a higher remuneration, they can get bonuses. So all you need is just read the question once. In the entire in this investment appraisal question, I believe there's only one thing was important to me, that was calculation of working capital, which I have explained. So that is why we are not going to now. Rest is very easy, not difficult at all. Still, whoever is solving that question, if you have any issue, you are more than welcome to ask. Always, no issue at all. Question 33. Look at this. Part A. Evaluate if Bright Path proposal is financially acceptable to Luminex Corporation. 8 marks. Now let's read which proposal they are talking about. Embarking on a journey to refine its working capital management and increase dividend payouts, Luminex Corporation Finance Manager is actively seeking strategies for improvement. Luminex Corporation generates annual revenue from credit sales amounting to 36 million. Credit sale is 36 million. Despite requiring all credit customer to settle invoices within 30 days, customers often take longer. Roughly 0.5% of credit sale results in irrevocable debts remain outstanding unrecovered. It means 0.5% of the sale is bad debt. Okay. Trade receivable currently stand at 5 million. Luminex Corporation incurs a short-term financing rate is 8. Okay. Considering a proposal from a factoring company. Okay, it's all about factoring. Brightpath offered to manage its sales ledger on a with recourse basis. Now, students, stop. In case of with recourse basis, logically, the risk of bad debt belongs to the company, does not belong to the factor organization. But in case of with recourse factoring, when you are hiring a factor and the factor company says, okay, we will be able to save your bad debt by, let's say, 10%, 20%, 30%. If factor company mentions that that after hiring us, your bad debt will be saved by X percentage, then you will show the saving of bad debts during the calculation, but according to the percentage which is mentioned by the factor company. If factor company says your bad debts will be reduced by 60%, then just take the saving of that bad debt by 60%. But when it is a non-recourse factoring, without recourse factoring, then your bad debts are actually insured, then 100% bad debt will be saved. But in case of with recourse, if factor is mentioning any percentage, I will take that percentage, otherwise I will not take it. It's a with recourse basis. Brightpath aims to leverage its expertise to reduce average trade receivable days to 20 days. Your new collection period will be 20 days. While cutting irrevocable debts, how much? By 80%. So irrecoverable debts, not revocable, irrecoverable debt by 80%. So it means whatever bad debt was there, 80% of that will be saved. So while cutting irrecoverable debt by 80% and lower administration cost by 120, saving in admin costs annually as a part of factoring agreement. Brightpath would advance Luminex Corporation 70% of the invoice value of the interest, and interest rate is 9%, which is 1% over and above OD. And if you remember, whenever we are calculating factoring costs, we always work on incremental approach. Like for me here, whatever factor is giving us in advance, 1% is important because they are charging 9%, which is 1% more than the OT. Brightpath would have levy annual fee 1.25% of credit sale, assuming. So student, we just need to calculate factoring costs. Obviously, if there is a net benefit on factor by hiring a factor, we will hire the factor. Otherwise, we will not hire the factor. If we are going to hire the factor, so we have to pay the factor fee. Your credit sale is 36 million, 1.25% of that. So 36 million. Just a minute. Students, I'm getting, it is 4,50,000. Obviously negative because we are paying fee to the factor. Now, interest on factor advances. Interest on factor advances, 36 million. Your new collection period is 20 days. You can see that. Out of 360. Factor is saying factor will give us the advance 70%. How much additional factor is charging? 1%. Because normal OD rate is 8, factor is charging us 9. Let's use the calculator. 36 million. Students, I'm getting 14,000. Interest on factor advances is 14,000. Okay. Now let's take saving in admin costs. Saving in admin cost is 120. Saving in bad debt by 80%. $36 million. Bad debt percentage is how much? 0.5%, means 0.005 into 80%. Because it is mentioned by the factor that bad debt will be saved by 80%. So 36 million. Students, I'm getting 1,44,000. Saving in the bad debt is 144. Now let's check saving in the finance cost. Existing debtors, they are 5 million. Just working. Saving in finance cost. Reduction in debtors into OD rate will give you saving in finance cost. Reduction in debtors into OD rate will give you saving in finance cost. Existing debtors, we have got 5 million. Revised debtors, your revised collection period is 20 days. We have 360 days in the question, not 365. I'm getting 2 million. Here comes the reduction in debtors. OD rate. OD rate is 8%. So OD rate is 8%. Saving in the finance cost is 2,40,000. So saving in finance cost. So let's see, if there's a net benefit, we should hire the factor. If there's a net cost, we should not be hiring the factor. Minus 4,50,000 minus 14,000 plus 120 plus 144 plus 2,40,000. Students, I'm getting positive 40. Net benefit. So since there's a net benefit, we should be hiring the factor. Otherwise, if there was net cost, decision would have been different. So students, in today's live revision class, section C was not the part of today's class, but since we completed section A and B little bit earlier than the time which I thought, so that is why I've just given you the idea of section C. I did not solve the entire section C, but I strongly believe after this idea of what I've given you in section C, I can assure you that it's guaranteed you can easily solve section C. Still in section C of FM, you have any question, you are always welcome to ask in your relevant WhatsApp groups. I'll do one more thing. I'll share the answer of this FM mock with you as well in your relevant WhatsApp groups, or otherwise I think answers are available online as well. So students, we are conducting these classes for all the papers as I mentioned earlier also, that is PM, FR, tax, SBR, AFM, and let's say ATX. So we are doing these classes for every paper. So student, that is all about today's class. Is there anything you want to ask, you want to say? So Again, I'm telling you, section C was not a part of today's class, but since we got the time, so why to waste the opportunity? So that is why. Again, if there's a question on dividend policy, also, if, for example, I just want to give you a little more idea. For example, my company wants to decide a dividend policy. So what factors I'm going to consider? Number one, I have to consider availability of cash. Just imagine, students, if your company wants to give dividend, your company wants to decide the dividend policy. So you need to check the availability of cash. Without the availability of cash, how can you make a decision on dividend? Number one, availability of cash you have to check. Second, you have to check the clientele effect also. Now, what do you mean by clientele effect? Actually, you need to see what your company was doing in the past. Now, listen, if in the past, if there's a history of the company, every year we are paying the dividend, so then there is no question. Then in the current year, you will also be providing the dividend. Why? You will also be providing the dividend because your shareholders, they have the expectation because of your past practices that you are going to provide the dividend. So normally that will create a pressure on you because you have a history of providing the dividend. So if I want to make a dividend policy, what factor I have to consider? Number one, I said availability of cash. Second, clientele effect. Third, I will also consider the number of investment opportunities available with the company. What do you mean by this? Now listen to me carefully. Students, if right now I have got number of opportunities where I can invest, so I will be least interested. BOD of my company will be least interested to pay the dividend. Why would I pay the dividend when there are a number of investment opportunities where I can invest the amount, and obviously by generating positive NPV, the share price will increase. So number of investment opportunities, technically they will restrict you from paying the dividend. Because if I'm going to provide the dividend right now and I do have the number of investment opportunities, it means that then for availing those opportunities, I have to raise the finance externally. So it means if I'm going to decide a dividend policy, so I have to consider availability of number of opportunities where we can invest. Okay. What other factors you will consider while deciding the dividend policy? I have to consider one more factor, which is covenant on the business, conditions on the business. What do you mean by this? There's a possibility my company might have taken a loan from the lenders. Okay. My company might have taken a loan from the lenders. And there's a possibility they might have put a covenant on my business that I cannot pay the dividend for next 3 years or 4 years. So it means paying the dividend right now means breach of contract. And breach of contract means the loan becomes mature immediately. So I will not be paying the dividend. It means if I'm going to decide the dividend policy, I have to check the covenants. Do we have any covenants on our business? What else I'm going to check while deciding the factors for the dividend policy? I have to see my financial gearing as well. Now, why you want to see your financial gearing? Always remember one point. If I'm not providing the dividend, I'm retaining that amount. That will actually increase my retained earnings. That will increase my equity. Of course, if it is going to increase my equity, it will have a good impact on my financial gearing. If I'm going to give the dividend, it will actually reduce my retained earning, and it will have a bad impact on my gearing, and my gearing will increase. So it means if you're deciding the dividend policy, so another factor which you are not going to ignore, it is your existing financial gearing. An impact of dividend payment on your gearing, you have to consider that also. One more thing which you need to consider the factor, that is, if we are providing the dividend, it will have a good impact on the company. Why it will have a good impact on the company? See, there's a possibility if you're providing a dividend, it might give a signal to the market that everything is fine in the within the company. Company is financially strong, everything is fine. That is why they are providing the dividend. So there's a possibility when you are providing a dividend, you might be showing that company is a wealthy company, which is not necessary, but it does have that impact also. When company is providing a dividend, it means things are really good within the organization. So students, these are the factors which you have to consider while deciding the dividend policy. Availability of cash, clientele effect, plus covenants point, plus availability of number of opportunities, dividend payment impact on financial gearing. So these are the factors which you have to consider when you are deciding the dividend policy. And Islamic sources of finance which would be available to this organization, you can say that they can go for muraba, they can go for mudarba, things like that. So students, now almost I've given you the entire idea of section C, even the theoretical part as well. Of course, as far as what you are writing, it is logical, you will get marks. So students, that is all about pre-scene mock from the ACCA section A, B, and in fact C also. So you can see that this one I've just discussed the factor to consider in shaping a dividend policy of a public. I've given you the factors. Check availability of cash, clientele effect, in current investment opportunities. If obviously if company is having number of investment opportunities, they will restrict the company from providing the dividend. You need to see the covenant on the company. You have to see the impact of dividend on your financial gearing. You have to see the dividend payment impact on the image of the company also. There are number of shareholders, there are people in the market, stock market, they will take it positive. They might be thinking, yes, everything is fine with the company is financially wealthy. Two Islamic instrument, mudarba and let's say go for musharaka. So you'll be just explaining mudarba, musharaka. So students, that is all about, I would say, pre-scene mock of ACCA September 25. I strongly believe we did discuss almost each and everything in a very limited period of time. So just the last minute of the class, is there anything you want to say? Students, we will be having another class on coming Monday as well, inshallah, the live revision class. And before that live revision class, I will share all the questions which we'll be discussing on coming Monday. Now it is officially. Thank you very much. Hope to see you all and others in the coming live revision.